Let's look at goodwill again. Thank you. Valuation, I told you. It is what? Purchase price minus the fair value. Whatever you paid over and above purchase price is obviously a goodwill. That's the resultant answer. Okay. And obviously in a consolidation, it is nothing but the value that you have in your books. Okay. So now goodwill is a very important thing. Let's say you record goodwill. What do you do after that? What do you do? This is critical. If the goodwill has an indefinite useful life, matlab, forever, it is going to be like McDonald's brand value. There's no fix. Like if you buy patent or trademark, the useful life only 7 years because you have to again renew the patent or trademark or copyright. You cannot keep it forever. So that is useful. But if the goodwill asset is going to be there as long as you survive, as long as the name is there, the goodwill will remain. McDonald's brand will continue. So what to do in that case? You will not depreciate it. You'll say, fine, it's always going to be there, so no problem. But you will, every year, you will do an impairment review. Means you will test, is this goodwill still worth, is Theobroma still worth 200 crores? What if the market has some bad name about Theobroma or something happen? Then the goodwill might come down, right? Like Facebook happened, right? So you need to check, is my goodwill still worth 200? Is it still worth it or is it become less? If it become more, no problem, keep it. Don't record it because there's no proof. If it will become less and you have proof, you'll have to impair goodwill. So what I do, I will annually test it for impairment. Annually. Every year. And to test it, I look at the value it is going to give me. Clear? Now let's come to the CFA part of it. As a CFA, you know that goodwill is a very intangible. You can't see tangible. How do you know the amount is correct? So as a CFA, you want to ensure that goodwill is not a part of your computation. Why? Because there's no assurance. There's no surety. There's no certainty that this goodwill is the correct value. So what to do? Ignore. Are we clear? Ignore it and let it be separately done. Ignore. I'm not saying to discount it or make it zero. I'm not saying to also change your profits. All I'm saying is ignore the value and ignore that it exists. So when I say total assets, I'll say minus goodwill. If I say total expenses, I'll say minus impairment if you impaired it. Do not take into account the goodwill asset or the impairment asset. Are we clear, guys? Any questions? Okay. So with that, we have now finished goodwill, intangible assets. Now after this, we'll move to tangible. So if any doubts, then only we'll proceed. No doubts so far? Okay, sure. This one will take, just thinking. Let me set the perspective if we go next part. Okay, so in the balance sheet, basically you see we have assets and we have liabilities, right? So let's focus only on the asset side. Within the assets, we have non-current and we have current. Okay. Now current is relatively easy, you can focus on it later. Within non-current, you tend to have tangible, correct, and intangible. Okay. Now intangible we have just discussed, that's normally all the goodwill and so on. Tangible, you normally will have fixed assets and others. That others could also be financial assets, which also are tangible but non-current. Like you have investments, correct? In fixed assets, you will have property, plant, equipment, right? Furniture and so on. So this fixed assets, this is financial assets. Both are tangible because you can see, touch them. Intangibles, you can't see or touch, and therefore we are separate. Okay. So in summary, I have tangibles and intangibles. I have now finished intangibles. Now I'll go on to tangible. Under that, we have investments and plant and machinery. Clear? Once you're doing this, all your non-current assets is over, then we'll move to current assets. Clear? Okay. Now under tangible, let's come to financial assets, right? Financial assets. What does financial asset means? It's an asset that is convertible into finance terms, money terms, right? That's called financial asset, money, right? Do you think plant and machinery is a financial asset? Plant and machinery? Answer, is a building a financial asset? No? Yes? Why no? Why no online? Answer? Because you need to know the difference, financial asset and non-financial asset or financial instrument. Okay, let's do one step. Monetary asset and non-monetary asset. Asset is asset, but monetary or financial asset is something that we convert into cash. Example, cash bank. Example, investments. They are converted into money. They are financial instruments or assets, right? But what was stock? Stock is not, because stock is first converted into debtors, and debtor is a monetary asset because debtors give you cash. But does stock give you cash? No. Stock gives you debtors. Stocks gives you receivables. Stocks is not saleable today. You have to first find the customer, then sell it to him. Then you may get cash. But before finding him, it is not a financial or monetary asset. Are we clear? So be very clear with what is a financial or monetary asset. Now, financial instruments that you see on the board is basically those instruments that are in financial terms, right? Converted to money. Okay. And within this, you'll have many classes. You'll have fair value, you'll have held at cost. Okay. Now, what is fair value? Fair value means which has a value. Let's say about shares. Your shares are worth 200. Market goes up 250, 300. The fair value is known to you. But let's say about shares in Flipkart. There's no fair value. They're not trading. So you don't know the fair value is because there's no fair value. So those will be at cost, right? Which you see on the board. Unlisted instruments. If it's listed, there's a fair value. If it's not listed, it's at cost. Here, so I have two types of instruments. One which is at fair value and one which is at cost. Now, what will be at fair value? Those instruments for which you can get a fair value. Right? Simple enough. Like listed instruments, even AFS, let's say income investments like derivatives, even those are having fair value. You can fair value derivatives using Black-Scholes model. So whichever instruments are capable of generating a fair value will be shown as fair value instruments. But things like unlisted shares or which are held to maturity or even loans, debtors. Do you think debtors value will go up, down? No, it's the same. You sold goods for 100, you will get 100 from him. You won't say, give me 120 tomorrow, 130 or 90. You will get 100 only. That's at cost. It's not fair value. Got it? So learn the difference. I have instruments and assets which are either at fair value or at cost. Fair value is those which have a value changing based on the arms market price. And at cost is those for which the fair value is not going up and down. It is constant. Like loans, receive. If you took a loan or you give a loan, the loan will be same. No, it won't be going up or down by fair value. But if you bought a share, the share price will go up or down and your value will go up or down. You bought a debenture, the value will go up and down. So all those instruments are fair value. Clear? So make a quick note of that. This is called financial instruments assets.